My goal is to really make this as interactive as I can to help you get answers to the questions that you may have and potentially answers to questions you didn't even know you had. So we're going to go ahead and get started and diving in. If you have any questions, feel free to post them into chat and I'll answer them as we move through. But my goal is to really give you an in-depth view to what it takes to buy a home in today's market. And we're going to talk about the market overall and where the market is at as we get through to the end. We're going to really start out with the home buying process. And we're going to talk about how to qualify for a home and the things that you've got to pay attention to. So I'd love to hear from everybody. Just post into chat. Are you thinking about buying a first home? Do you own a home now and thinking of buying, of upgrading or downsizing, or is this some other purpose? So I'd just love to get a feel for kind of what everybody's current situation is. So we've got one person that's looking to purchase a new home. That's fantastic. First home, fantastic. And if everybody else can kind of fill me in a little bit on what your plans are, why you're here and what you want to get out of it, I would love to hear that. In the meantime, we're going to go ahead and dive into the actual presentation. And I'm going to start with a big question that I get all the time from my clients, and that is, what does the bank care about? And a lot of people ask me, John, why does the bank want to know certain things? What do they want to know from me? Why do they want to know those things? And what do they care about? And so that's a really big portion I want to spend some time with this afternoon or this evening, I guess, is helping to explain that and how it works. So there are three major things that mortgage companies care about. And it's cash. So cash is obviously the amount of money that you have in the bank to pay for down payments, closing costs, and reserves. So those are what we care about with cash, is how much money do you have for down payments, closing costs, and reserves. The second thing we care about is credit. Credit being the indicator of how well you've paid your bills in the past, because that's the best way for us to predict how well you're going to pay your bills in the future. And I think people misunderstand credit, and they think that, you know, hey, John, if I have enough income, obviously I'm going to pay you, but the bank is worried about, what are you going to do with the income that you're receiving? Are you really going to put it towards the correct priorities? And that is paying for the home mortgage. So that's something really, really critical, is credit. And then the final thing that we care about is income, because no matter how good your credit is, no matter how much down payment that you have, if you don't have enough income on a monthly basis to pay your monthly mortgage, credit cards, car payment, it's impossible to succeed in owning a home. So those are the three things we care about: cash, credit, and income. Now I'm going to dive into each one a little bit and talk about things that matter and how we think about that. And again, at any point, if you have questions, feel free to post into chat, and I'll be paying attention to chat as we go through here. So cash, there's really three things that we look at, as I said. Down payments. Now I'm going to have a down payment or low down payment loan options. Oh, I froze. Uh-oh. That is not good. Hold on one second, gang. I am going to, can you hear me again? Looks like you can. All right. Okay, give me 1 second though. I'm going to double check to make sure that my connection is good. So bear with me as I stop my video for a quick second. I'll be right back. All right, well, hopefully that's going to work better. Thank you for letting me know. Please fill me in. I see Maxine said start from the beginning of cash. So when you are purchasing a home, you're going to see advertisements and you're going to see people say, hey, we've got a loan program that has 0 down payments, or 3% or 3.5% or 5% down. Well, that's only part of the equation, because you also have closing costs. Now, closing costs, I'm not going to go into too much detail on what the closing costs are, but I'll give you an idea. When you buy a home, You've got to pay for the appraisal on the home that you're buying. You've got to pay for the title company to do their job. Now, a lot of people misunderstand or don't even understand in the first place, John, what the heck is the job of the title company? The title company's job is to act as the neutral third party to make sure everybody gets what they want. Now, kind of what that looks like to me is like when we were on the playground as kids, or at least when I was on the playground as a kid, and I had a baseball card that I wanted to trade with a friend of mine who had another baseball card. Problem is, I didn't want to give him my card because I'm afraid he would take it and run away. And he didn't just want to hand me his card first because he's afraid I'd take it and run away. And so we made a deal. Let's teacher. And I'll give my baseball card to the teacher and you give your baseball card to the teacher and she'll swap and hand us back the card that we expected. That's a neutral third party. That's what the title company does. Because when you buy a home, you want to make sure the person selling it to you really owns that home. You want to make sure that the person who's selling it to you doesn't owe a bunch of money to somebody that didn't get paid off, and now they're going to have a claim against your home. So you have to pay for title insurance, and you have to pay an escrow fee for the escrow company to manage that trading of money. So those are just a couple examples of closing costs. Now I'll get into some dollar amounts of closing costs in a few minutes, but that's the second piece of cash that you have to be worried about is closing costs. The third piece is reserves. Now, reserves is extra money left over after you pay for your down payment and your closing costs. Now, here's the funny thing, and I'm not sure I would say it's funny, the most interesting thing about reserves. Most loan programs don't require any reserves. You can buy a home, and as long as you're not doing a jumbo loans in most markets are loan amounts over $730,000. So as long as you're not doing a jumbo loan, in most situations, I don't care if you have extra money in the bank after you pay for your down payment and your closing costs. But my personal opinion, it is the single most important factor for success long-term in owning a home. The truth is, you're making a big shift if you're a renter right now and you want to buy a home, because you're going from having somebody you can call and say, hey, there's a pipe that's leaking or the toilet's backed up, come fix it. And you don't have to write a check for it. Somebody's going to show up and fix it. To being the person that not only has to deal with getting it fixed, you've got to pay for it. Now, there's ways to deal with that through what's called a home warranty. And you can get a home warranty so that you don't have to worry about paying for significant unexpected repairs, but it doesn't cover everything. You're going to run into an issue where you're going to need to get your roof replaced at some point in time. Having extra money in the bank has made the difference over my 22-year career between the people that I've seen that have thrived as homeowners and the ones who have struggled. So the challenge is for a lot of people, they don't have any extra money to put into savings. They're scraping by just to come up with the down payment and the closing costs. Now, is that a reason not to buy a home? No, but I'll tell you, your first goal once you own your home is to build reserves. That is a huge takeaway that I want you to remember is once you own a home, if you depleted all of your reserves to purchase the home, you need to start building your reserves back up right away. Now, sometimes that means changing your investment strategy. Sometimes it means pulling back a little bit in the money that you're putting into the 401k or the money that you're putting into other investments, or scaling back a little bit on some other spending to rebuild that nest egg. My recommendation for reserves is 3 months of all of your payments. So if you take what you've got in your new house payment, what you're paying in credit cards, car loans, student loans, food, groceries, gasoline, all of that stuff, your ideal number is 3 months of reserves. So once you purchase a home, if you've depleted below that number, start focusing on building it back up as your first goal before you worry about investing in anything else. So that's the most critical thing I'll tell you about cash is make sure that long-term you're focused on maintaining reserves. All right, so let's talk about some cash issues. First of all, let me move my chat box out of the way so I can see it. Okay, so seasoning. Cash seasoning is a major issue. And what seasoning means is how long has the money been in the bank? Now, people misunderstand this and say, well, I can't use money unless it's been in the bank for 2 months, because that's what I heard. Well, there's some truth to that, but most things and most myths are really based in a little bit in truth and a lot in misunderstandings. And so the truth is, if the money appeared from nowhere, if it was cash, which is actually the second thing I'm talking about, cash is a 4-letter word. My son was watching me, by the way, as I was creating this, and he goes, wow, Dad, that's profound. He's 14 years old, so he's in the sarcasm stage. And he goes, Dad, that's profound. Cash is a 4-letter word. People are going to flock to your webinar so that you can tell them something so profound that cash is a 4-letter word. Thought you might find that humorous. I did. Anyway, so the truth is cash is a 4-letter word, meaning it's a bad word. It's profanity. When I'm talking about green pieces of paper with pictures of presidents on it. So if you keep your money at home in cash, like literally green pieces of paper with pictures of presidents, and you put it in the bank, I can't count that money. I can't count the money because I don't know where it came from. Now you're going to say, John, I took pictures of it on my bed. It came from the shoebox underneath the bed. But I don't really know if you just borrowed that money from a credit card as a cash advance. It's even worse, because sometimes people will say, well, look, my dad gave me a gift. He took $8,000 out of his bank account, and I can show right here the withdrawal. And 15 minutes later, I deposited $8,000 into my bank account. The truth is, in my industry, the mortgage world doesn't know for sure it's the same $8,000. Now that's common sense says, come on, John. At 12:02 p.m. at the Wells Fargo on the corner of 5th and Main, Dad withdrew $8,000. And at 12:12 p.m., 10 minutes later at the Bank of America across the street, I deposited exactly $8,000. Is that just coincidence? Well, the bad news is in the mortgage world, yeah, we kind of look at that as just coincidence. So cash is never okay. If you have cash you're using, there's 2 ways to use it. One is to put it in the bank and wait 2 full bank statements. So I've got to be able to get 2 statements that don't show the cash coming in. I've got to show that it's been there since the beginning of those 2 statements. I only look back 2 months. So if it was deposited 3 months ago, I don't care. So that's an important thing to realize is you can put the cash in, but you got to wait 2 full months. By the way, I'm about to sneeze. Hold on. Excuse me. So that's something important is if you deal in cash, and I don't mean to say deal in cash, but if you have cash, if you saved money in cash, 2 ways you can use it. One way, thank you, Gideon. One way is that you can deposit it and wait 2 months. The second option, get a gift from a family member instead of using your cash. And if later on you want to re-gift them back the cash that you have, that is none of my business. But the key is that they have to have gifted you their money. You can't give them the cash and they gift it right back to you. So we can work with cash, but it has to do with if you leave it in there long enough to be seasoned, or if somebody else can give you a gift instead. But one of the other issues is documentation. And that's really the key, is how we prove the paper trail. The biggest mistake I see people make is they say, John, I wanted to simplify everything. And so I moved all the money from all of my accounts into this one account so that I just have to prove to you this one statement that says I have my $45,000. The problem is I'm going to look at that account and I'm going to see all these deposits from other places over the last 2 months. And I still have to go chase down all of those other statements to prove where the money came from. So that's going to create even more struggle. Don't try and consolidate your accounts to make it easy, because when you move money, I've got to prove where it came from to prove that it didn't just magically show up in cash in the last 60 days. So the key is always we're looking backwards, 2 full bank statements. That's another challenge, is the definition of 2 full bank statements. Let's pretend that your bank statements run from the 1st through the 31st. Very few of them do. But let's pretend they do. Then right now we are on, what is it, the 19th of January. So your last bank statement right now would be December 1st to 31st and January 1st to the 30th, which means if you deposited money on November 2nd in cash, you would say, John, it's been over 60 days. That money doesn't matter anymore. It's seasoned. No, it's not, because I'm going to ask you for the two most recent bank statements, and that's the December and the November, and I'm going to see the cash deposits. So it's really important that you understand we're looking at two full statement cycles. So you have to wait until the January statement comes out. So I'm looking at December and January. All right, so documentation is really, really important. It's important if you said, John, I'm selling a car. Can I sell a car and use that money for my down payment? The answer is absolutely, but I gotta prove it, and I have to prove it correctly. Remember, I said cash is a four-letter word, so don't use cash. Now, if you sell your car and somebody pays you cash, it's a problem. I don't know if that cash really came from the sale of that car, which means when you sell your car, you've got to get, now you don't want to get a personal check, because who's going to turn over your car with a personal check? You have to get a money order. You have to get a money order or a cashier's check that shows the name of the person who bought your car on the cashier's check or on the money order, and they need you to keep a copy of the money order. On top of that, I've got to actually prove three other things when you sell an asset, a car being an example of an asset. So the three other things that I have to prove is I have to prove ownership. Did you own it? So I need to get a copy of the DMV record to show you were the owner of the car. I need to prove value, because if you sold somebody a car for $8,000, it was only worth $2,000, there's some shenanigans going on, and we're going to have an issue with that, because really you're trying to cover something else up, because why would somebody pay you $8,000 for a car that has a blue book value of $2,000? So we're going to want a blue book value. Doesn't mean it has to be exact, but it's the detail of documentation that we need. And then we need the proof of sale. So I need a written bill of sale signed by you and by the buyer, because that way I can piece it all together. I can prove the ownership is in the name of the person who's the seller on the bill of sale, and I can prove the cashier's check or money order came from the person who's the buyer on the bill of sale. Then I can use that money. So those are just some simple examples of how documentation works. The most important thing I'll tell you is talk to me before you move any money. Talk to me before you sell something. If you say, hey, John, I want to borrow money to come up with my down payments. It depends. You can borrow money against an asset, your 401k, a home, your car, but you can't borrow money that's not secured against something. Why? Because the rule makers say so. And I hate to say it that way because it sounds pretty, how should I say, let's put it this way. They are the ones that are giving you $250,000 to $500,000. They get to write the rules the way they want it to be written. And so that's Fannie Mae, Freddie Mac, FHA, and VA. They write these rules. And they said, look, we'll let you borrow money if it's secured, because we know that there's an asset that it's secured against and you're likely to repay that. But if you borrow money against a credit card, there's just more risk associated with it, and they just don't like it. That's the simplest answer I can give you. Now, the final thing I'll tell you is timing is often misunderstood. The fact of the matter is, I need to know where the money is at and where it's coming from before I can issue you a pre-approval. But I don't actually have to have the money ready until after you're in contract for a home. I don't have to have the money ready until about a week before you complete the escrow period. The escrow period is the time between when your contract accepted and when you become the homeowner. And so you have time to move the money around, so don't freak out. Now, if you have cash, you need to get it deposited right away. But talk to me first about your details. The biggest thing I'll tell you that people make mistakes about is taking information they learn on the internet and trying to apply it as fact. Trying to say, oh, well, I heard that on the internet. Well, guess what? This right now is on the internet. So everything I'm telling you, I don't want you to apply. I want you to understand. I want you to digest and have good questions to ask me so that when you're ready to sit down with me, we can discuss these issues. But when I thought about, hey, what is a masterclass and things that I need to teach? It really is about giving you the knowledge of the things you have to pay attention to. And more importantly, is giving you the permission to not actually take any action until we talk. So that's critical that we understand that. The timing of money is 2 times. You need to have money when you write your offer, and that's in 2 ways. Earnest money deposit is given to the seller as good faith that, hey, I'm really serious about buying the home, so I'm going to give an advance towards my down payment and closing costs. And then you've got to pay at the time you get your offer accepted for an appraisal, and you have to pay for inspections, and we'll talk more about that a little bit later. And then none of the rest of the money is needed until about a week before you're scheduled to get the keys. So we have some time to liquidate your 401k assets, or we might not have time to sell the car. Okay? I'm worried if people say I'm not going to sell a car until I get an escrow, but we've had time to move stuff around. We have time to get the gift from mom and dad if that's what we're doing. And that's the last piece I want to explain about assets is gifts are acceptable on any purchase except investment properties. So if you're buying an investment property, you can't use gift money. But otherwise, you can use gift money in most circumstances. And I'll tell you that the bank of mom and dad helping you or family members helping you to come up with a down payment is the least expensive way to get a down payment. At least it's the least expensive financial. There might be an emotional cost to getting money from mom and dad, but financially it's less expensive and it's a good option to consider. Remember, if you have questions, please post them into the chat. I'll be happy to address them as we go. And I want to make sure this is interactive as I can to help answer your questions. So I'm going to move on from cash, unless anybody has any questions about cash or something specific they want me to cover. And I'm going to talk about credits. Actually, I might not. I'm not going to talk about credit. I'm going to talk about funds to close. So this is where people say, hey, John, I saw a program where I only need 3% down, and I saw a house that's $300,000. So I need $9,000 to buy the home, and I have it. The problem is you've forgotten about closing costs. Closing costs average about $10,000, and in a lot of cases, they can go higher. We could be theoretically upwards of $15,000 in closing costs. Now, I talked earlier about what some of those costs come from, but you're also prepaying for homeowners insurance, you're prepaying for property taxes, you're paying the lender for underwriting and credit report and processing of the loan. There's origination fees for us originating the loan. So it's critical to understand that no matter what the down payment percentage is, you're going to have closing costs on top of that. And so you've got to really be aware of what that true number is. All right, so Roshana has a question. If we have a balance in the bank for down payment of 14 to 20%, is it available to do an assistance program? Like Roshana, you're talking about like a down payment assistance program? So I'm going to repeat the question and just want you to clarify. Basically, what you're saying is, hey, if I have a good amount of money in the bank, do I have to use it? Or can I use down payment assistance instead? I think that's what you're saying. If I'm wrong, please clarify. If I'm right, just say yes. I'm going to answer that question anyway, and then I'll clarify if I didn't answer it correctly or didn't understand your question correctly. The answer is, so no, I don't understand it correctly. All right, then do me a favor, type your question again, and I'm going to answer the question that I thought you were asking first. Some people think if I have money for down payment, I have to use it, but I can't use a down payment assistance program. That isn't true. Down payment, there's a couple down payment assistance programs that will limit the money that you can get because you have your own funds. You have the ability to come up with a down payment. But that's very, very rare. Most down payment assistance programs don't care how much money you have. If you want to use the program, you can, but it comes at a cost. Okay, so Roshan, I'll answer your question in just a second. Down payment assistance is not free money, even when it's a grant. They're going to say, John, are you crazy? I'm looking up in the dictionary right now. A grant is money you don't have to pay back. That's true. But if I gave you bought a $300,000 home and I gave you $9,000 grant to buy that house, you're borrowing $291,000, but I'm going to charge you a significantly higher interest rate on the $291,000 because I gave you $9,000 for free. Is it really free money? So if you don't have money for down payment, or it's the only way for you to keep some money in reserves, I think it's a great option to use down payment assistance if you qualify. But don't use it simply because you think it's free money. The interest rates and the closing costs for down payment assistance programs are higher than the interest rates and closing costs when you use your own money. Okay, so Roshana clarified her question. Let me just slide up here really quick. Is down payment assistance available to help pay the down payment? The answer is 100% yes. I've got 3 different down payment assistance programs that I can use, and we've got a couple more that are coming online soon. So if you are concerned that, hey, John, that's my biggest hurdle, is I can't come up with the money to buy a house between inflation and the price of gas. I'm barely paying for everything, but I can afford a house payment, especially because I'll get the financial benefits of owning a home. I'll get the tax write-off and all that stuff. Then yes, there's actual assistance money available now. I've helped, in the last 2 months, I've helped 6 people who purchased a home using down payment assistance, and they're really good programs. So let me break down kind of how this works on the slide you're looking at. There's 5 ways to pay for your down payment and closing costs, but only 3 of them can apply towards down payment. The other 2 go towards only closing costs. Okay, so your own funds can be used for down payment or closing costs. Gift funds can be used for down payment or closing costs. And a down payment assistance program can be used for down payment or closing costs. But on top of that, you have 2 other ways to pay for closing costs, and that is a seller credit and a lender credit. And I'll start with me and say, John, why would a lender offer a credit? Because we're going to earn more interest over the life of the loan. If I charge you a higher interest rate for the entire length of your loan, I'm going to make more money than what I helped you up front with to help pay closing costs. And 2 or 3 years ago, that was very, very common. We had a lot of options to help you pay for closing costs. The problem is interest rates have gone up significantly. And that significant increase in interest rates means we don't have room anymore on top of it to add even more to cover your closing costs. So in today's market, a lender credit for closing costs isn't really a viable option. But the opposite is true with seller credits. 2 years ago, sellers wouldn't give you a credit at all. Why? Because there were 10 people trying to buy the home. Why in the world would they give you part of their price, part of their profit to help pay your closing costs when there's other people beating down their door, begging them to let them buy their home? But times have changed. And I'm going to talk a little bit more about the market and where I think it's going towards the end here. By the way, I scheduled this for up to 90 minutes. So if you have to leave early, let me know and I can send you the recorded copy. Hopefully everybody can stick around here. We'll definitely be done by 8:30 with time for Q&A, but I just want to make sure you guys have the heads up of timing. So your change is right now, buyers are not very active. There's a small window right now where over the last 6 months, a lot of buyers have said, you know what, I'm unable to pay these higher interest rates, or I'm unwilling to pay these higher interest rates. And so they've stopped shopping. And what it's meant is that the buyers who are shopping right now are able to get a better deal from the seller and have the seller pay some or all of their closing costs. So when we lost 2 years ago, sellers wouldn't help, but lenders would. Right now, lenders won't help, but sellers will. So it's a shifting opportunity, but it's really important to understand how much money you're going to need and where you can get it from. All right, I'm going to move on past down payment and cash, and we're going to talk about credit. If anybody has any other questions about cash, feel free to post it into chat and I'll circle back on that. All right, so let's talk about credit. Credit is how well you've paid your bills in the past. And there's a lot of pieces to it. The reality is credit really determines your interest rate. Your down payment determines your interest rate a little bit. Your income does not determine your interest rate at all. Let me say that again. I don't care if you make $1 million or if you make $50,000. If you have a certain credit score and a certain amount of down payment, you're going to get the same interest rate whether you make $50,000 or $5 million in income. Your income is a yes or no question. I'll talk more about income in a couple minutes, but income's either you have enough or you don't. Credit is shades of gray. Credit says, how serious are you about paying your bills on time? Now, the credit system is designed to recognize one-time occurrences, and it's designed to forgive them a lot faster. If you had a challenge with your credit and you couldn't pay any of your bills for 3 months, but then everything got on track again, and you were good before that for the 5 years before that, and you've been good for the 2 years after that, your credit's going to be really, really, really good. Because it's clear there was one time that you had one problem and it was bad, but you weren't bad before that and you weren't bad after that. The opposite is somebody who has a pattern of, well, I missed this credit card payment here. I was kind of late on my car over there, but who cares? They got a late fee from me and they should be happy because they made extra profit off of me. If I pay late, you guys get extra money because you charge me late fees. Who cares? That's the attitude we're most afraid of. That's the concern, is what I call slow payment history. In other words, you miss something a little bit here, you miss something a little bit there. We can't blame it on one issue. We can't say, oh my gosh, they had a medical issue, they had a death in the family, they had whatever, a job loss, but they were good before that, they were good after that. The issue comes down to the more spread out or sporadic your late payments are, the more your credit is going to be impacted for longer periods of time. So you need to worry, and if you have challenges with credit, I've got a full 1 hour video webinar on my YouTube channel. If you don't subscribe to my YouTube channel, please do. It's search for John Loan King on YouTube, and you can find me on there, and I've got all of my videos there. I do regular market updates, a lot of videos about the home buying process that will dive in deeper into these topics. But the fact is, credit is one of the biggest challenges that we have to address with first-time home buyers or even move-up buyers that they didn't think was as big of an issue as it is. There's a lot of myths about credit. There's a lot of misunderstandings. And the most important thing I'll tell you about credit and the myths and misunderstandings is it's kind of like going online to diagnose yourself if you have a medical ailment. Who's done that? Come on, we've all done it. You go online, you diagnose, you say, hey, I got this ache and pain, and I don't know what it is. And so I go on to WebMD and I'm looking up to figure out what is it that it could be. And the truth is, that is going to get you down some rabbit holes that may or may not be true. But let's take it one step further. Let's pretend that you went on WebMD and it says, oh, you've got this problem, and people with this problem normally take this medicine. And you say, oh, that's cool, because I'm in luck. My uncle used that medicine just last month, and I know he has some left over. I'm going to call my uncle and have him drop off those pills so I can take them because that'll solve my ailment. The truth is, your uncle's pills might kill you because your uncle's medical history is different than yours. So even though that pill is designed to address that same issue, and even if you have exactly the same ailments, the fact is that you might be allergic to that medication. You might be taking a different medication that might counteract that medication and cause problems with both. Now, John, how does this apply to credit? It applies to credit because you're going to have a friend who said, hey, I fixed my credit because I just closed all my credit cards and cut up my balance credit cards, and my credit now went up by 100 points. Well, that person might have had a different set of challenges, a different set of ailments. and you close all your credit cards and cut them up, and it might drop your credit score. Some people say, hey, I opened up credit and it helped my credit score. That might hurt yours. So I'm not going to talk about what it's going to take to improve your credit. What I'm going to tell you is don't listen to anyone, including me. Don't listen to my credit video on YouTube and say, oh my gosh, John, I listened to what you said on there and I went ahead and did it. Every one of my videos, when I talk about credit, I say the same thing. Don't do what I'm telling you, because this is a theoretical example. You need to get an expert, me, to pull your credit and take a look and see what your true ailments are. Okay. One of the myths is, I don't want my credit pulled because it's going to cause an inquiry and that's going to hurt my credit score. First of all, to do a mortgage, I do need to do a full inquiry, but I can do a soft credit report if you aren't ready to pull the trigger now, or we're just not sure. I can do a soft credit pull. That means it doesn't show up on your credit history and it's not going to impact your credit. I get one or sometimes two credit agencies, and I can get kind of a peek behind the curtain to say, hey, what's your credit score look like? So my biggest masterclass advice for credit is two things. First of all, be cautious of the credit scores you see or find online, because they're not the same score I'm going to use for a mortgage. Okay, I'll explain more about that in a second. But the second thing is, if you think you're going to be buying a home, come to me and I can at least do a soft credit pull. I'm not going to charge you anything for it. It's not going to hurt your credit and show up on your credit report. And anybody who is attending this masterclass, you have that offer where I will do a soft credit pull for you and not charge you anything for it. There'll be a QR code at the end where you can fill out some information and I'll get back to you if that's what you want to do. But it allows me to run my credit simulator. My credit simulator is really the answer to this last question about, hey, should I fix it myself or should I pay someone else? The truth is, there's nothing you can pay somebody to fix on your credit that you can't do yourself. Now, there's nothing that I want to pay somebody to mow my lawn that I can't do myself. I just don't want to take the time to do it. That's a true statement. And there's a lot of people we pay to do things just because we don't want to do it ourselves. But credit's one of those things that the companies that advertise, I'm going to clean something off your credit and erase it, what they're doing is lying on your behalf. They're sending a letter to the credit card saying, hey, I was never late. This is untrue. Prove to me that it's true. But you know that it's true. You're just trying to get them caught in a loophole where they can't get proof that you were late soon enough. But sometimes that backfires. Sometimes it actually makes an old account look new again. And a new late payment is worse than an old late payment. So there's issues with that. You've got to be super, super careful. But I can run a credit simulator that says, what if we pay off this credit card? What is that likely to do to the credit report in 1 month? What's it likely to do to your credit report in 3 months or in 6 months or 9 months? So I can play with adding or deleting credit cards, updating balances, changing your payment history, as well as time. So my simulator is something I'm offering you for free that I will be able to run and give you advice. Now you need to execute the plan. I'm not going to write letters for you. I'm not going to call your credit card company for you. You can pay somebody to do that, but it's not that hard to do. What you need is the right advice, and I will give that to you for free. Now back to the actual credit scores. Excuse me. The credit scoring system is confusing because you have different credit models. It's very much like the measurements. When you look at inches versus centimeters and you're trying to convert something, it's like, well, wait a second, I need this much. Is that in inches or centimeters? Well, they're different numbers and they represent something different. So even though something is this big, it's a different number if it's inches and it's a different number if it's centimeters. And the fact of the matter is your credit's viewed the same way. There's different scoring models. Now, if you really want to get your correct mortgage credit score, you need to go to myfico.com. If you go to myfico.com, you will be able to buy your credit report and buy your credit scores. And myfico.com is the only place that I know of where you can pick, I want to see my mortgage score. And that's the key, because any other score but the mortgage score, and you're going to say, oh, John, I'm ready. I've got a 640 credit score. Well, no, that's a different scoring model that's used for automotive or used for credit cards. It's not used for mortgages. So a big myth, a big misunderstanding about credit is about where you got your score. So I will do a free soft pull for you, or you can go to myfico.com, pay for it. I'd go with me, it's free, and I get to give you the simulator for free as well. All right, so I think that's it on credits. Let me check. Yep, so before I move past credit, want to make sure you guys know if you have any questions about credit, feel free to post them into the chat, but I'm going to move on right now and talk about income. So income is a yes or no question. We're not worried about how much extra money you make, because the truth is, if you have poor credit, but you have great income, that's the scariest buyer for a mortgage company to approve. Think about it. They make really good money, but they don't make good choices on where to spend it. I'm worried. Like, you make a whole bunch of money and you have bad credit, and it's especially if it's bad credit over a long period of time where we can't just explain one issue, and it feels like you don't care. And I'm not passing judgment, but it looks like that. And that's the biggest worry to somebody whose the bank's livelihood is based on you paying them every single month on time. So here's how credit works, or how income works. We look at your gross income before taxes. So if you make $20 an hour and you work full-time 40 hours a week, then we're going to take that number, $20 times 40 hours a week, and that essentially comes up to about $40,000 a year, or about $3,300 a month. So that's your gross income. And let's pretend that your spouse makes, $120,000 a year. So between the two of you, there's $10,000 from your spouse, $3,300 from you. So that's $13,300. I will let you spend, in most cases, between 45 and 50% of that number towards your credit cards, car payment, house payment, student loans, any debt that shows up on your credit reports. So in that case, you'd be able to have about $6,600 in mortgage payment, credit cards, car payments. Now you said, John, I've got, I co-signed for 3 family members' cars, and I've got $2,000 worth of car payments. Then I got to subtract that from the grand total. So if you could spend a total of $6,600, I got to subtract the $2,000 in car payments, which means you can only spend $4,600. Now I'm using just ballpark numbers here. I'm not using real numbers for a real scenario as much as I'm trying to explain the concept. So when people say, John, how much do I qualify for in a home price? The truth is, you don't qualify for a home price ever. You qualify for a maximum monthly payments. And because interest rates change and don't get locked in until you get an offer accepted on a home, I'm going to tell you, hey, you qualify for $500,000 because the payment on $500,000 is $3,500 a month, and you qualify for a $3,500 a month payment. But if interest rates go up, the payment on $500,000 went to $3,700, and you didn't qualify for $3,700, which means you don't qualify for $500,000 anymore. It is one of the biggest misunderstandings when people say, how much do I qualify for in a home price? We're going to tell it to you in a home price, but we're kind of crossing our fingers and hoping that rates stay the same or go down, or I build a little buffer in there and I say, well, you qualify for $3,500 a month. And right now the payment for $500,000 is exactly $3,500. So I'm going to tell you only qualify for $480, because what if rates go up a little bit? So there's a lot of estimations that are done in the mortgage world because we don't know all the exact numbers. We don't know how much the property taxes are going to be on the house that you're buying, because property taxes are specific to that neighborhood, and they can be different from one neighborhood to another within the same city. So it creates a challenge for me, especially as you look at buying a home in high wildfire danger areas. If you're looking to buy anywhere in the foothills, and the sad truth is, even not in the foothills, a lot of homes are in a high fire danger area. And that means you have to pay higher insurance for fires to protect against a fire. Well, that means that I'm guessing on a $500,000 home, your payment's $3,500 a month, including property taxes and insurance. And by the way, that's not a real guess. It's just a number. It's just a fake number. But if you buy a home that is in a high fire danger area, your fire insurance could be an extra $1,000 a month. Then you don't qualify for $500,000. So it's about communicating well with your lender. That's me, by the way, so that you and I are on the same page on what you're trying to accomplish. These are the kind of details that cause your friends to say, man, I'm never buying a house because every time I try, I get all the way to the end and the bank says no. The bank never says no at the end. The loan officer didn't understand what to ask you in the beginning. So it's critical you pick the right loan officer, that's me, by the way, who's going to guide you through this process and help make sure you don't hit those pitfalls. So here's what, in general, we look at for income. We look at a 2-year look backwards. Now, a lot of people misunderstand and they say, oh my gosh, I have to have been employed on my employer for 2 years. No, that isn't true. We are looking back 2 years for your stability of employment and maybe to calculate your income if your income is variable. Now, variable income is a buzzword right now with mortgage banks because Fannie Mae and Freddie Mac are really cracking down on this. And what they're concerned about is, look, somebody says I work full-time 40 hours a week, but they're not paid for holidays. So this week was Martin Luther King and they were closed on Monday. And so they only got 32 hours of pay this week. Then I can't calculate your income as if you worked 40 hours every week because you don't get paid for holidays or you don't get paid for sick time, or your boss gives you the option. This is one of the biggest problems. Your boss gives you the option to go home early on Saturday or on a Friday without having to pay for you're not getting paid for it. They're saying, hey, you want to go home at noon? You can, and I'll just only pay you for 4 hours today. So you can do that. The problem is then I treat your income as variable and I've got to go back and average your income over the last 2 years. But that's not a problem for people who are working a consistent schedule. I don't care that you've changed jobs. I don't even care that you've changed industries. The fact of the matter is, I look at, is your income predictable? And if it is, if it's stable and predictable, I don't care that you've changed jobs in the last 2 years. Now, the next thing I want to talk about is the look forward. We want a 3-year look forward. Well, what does that mean, John? Roshana, you asked me a question just now and you said it in a direct message. So I'm thinking that this is something you want me to address with you later. If you want me to address this question publicly, let me know and I'll do that. Otherwise, I'll get with you offline tomorrow. So the bottom line is that the 3-year look forward is about us as a lender being confident that the income we're qualifying you for is not going to change in the next 3 years. Now you said, John, I can't guarantee I'm going to have a job in 3 years. You're right. You can't guarantee your employer is going to keep you there in 3 years. But do we have any reason to believe that you're not going to be there? In other words, do we have a contract that says, hey, you're only a contract employee and your contract ends in a year? Well, if that's true, then I just have to have a history your contract is renewable, okay, or has been renewed in the past, and then I'll assume it's going to be renewed again. It's more about short-term income sources. If you're on disability, which disability is a whole other thing. So let me not say disability because that one creates disability. By the way, you can get a loan even if you're on medical leave, disability leave, and the mortgage industry cannot discriminate against you because you're on leave and because you're on disability. But we still have to make sure you have enough income to make it through the time before you get back to your normal pay. So I'm going to not use disability as an example. I'm going to use an example of child support. That's actually a really good, pertinent example. If you are receiving child support income for a child that is 17 years old, well, child support typically ends when somebody's 18. And unless your agreement with the parent, the person who's paying you the child support, that the child support's guaranteed to continue until they're 21, then we don't know that it's going to last 3 years. Most child support agreements say until they're 18, unless they're in college, in which case it goes until the age of when they graduate college or 21 or whatever. But that's or. It's only if they're in college and it lasts past 18. Your kid's 17, I can't guarantee you they're going to stay in they're even going to go to college. And even if your kid's 18 and in college, that doesn't guarantee that they're not going to quit. And as soon as they quit college, you quit receiving spousal or child support. So that income cannot be predicted to continue for 3 years. I can't count it. So child support is an example. If you have a child you're receiving child support from that is older than 15, it's 15 or older, I can't count the income from that person because it doesn't meet the 3-year look forward. All right. Now, how we calculate income, I'll tell you, it's not as challenging as most people think if you're a W-2 employee. The bad news, Gideon, is it's more challenging than you think when you're self-employed. Okay. I talk to a lot of business owners and they say, John, I don't get it. You're giving me a hard time wanting to buy a house that's cheaper than the house one of my employees bought from you last month. How is it? I'm their boss. I run the company and they work for me. And yet you had an easier time giving them a loan and you're giving me a harder time getting a loan when I'm a step above where they are from an income perspective. And it's about predictability of income. Here's the truth. For self-employed people, you've got to struggle every single year that's about to start. And that's the struggle with how do you pay the IRS the least amount of income. And the struggle is real. I think it's very, very important to not overpay your silent partner. By the way, your silent partner is Uncle Sam. They get part of your profit no matter if you like it or not. And so you want to make sure you're minimizing what you're paying to that silent partner. But that silent partner is also in charge of where all the money comes from for mortgages. And they're not going to let me qualify you for the best mortgage programs if you're not reporting that income to them as taxable income. So if you are self-employed, the masterclass key that I want you to take away from this call tonight is you need to show me your taxes before you send them to the IRS. Because once you submit your taxes, that's it. You can amend them, but the original copy is always part of the record. And the mortgage industry will not believe that you amended your taxes for any other reason than to try and qualify for a mortgage. And they're going to believe the first version is the truth and the second version is a lie, only to help you qualify. So what you need to recognize is you have the opportunity over the next 8, 9, 10 months, because you can postpone filing your taxes until as late as October 15th. And show me, go to your tax preparer, prepare your taxes, don't submit them to the IRS. Instead, send me a copy. I'll review those taxes and I'll give you advice. I grew up in a household, my dad was a tax preparer and an enrolled agent with the IRS. Well, he wasn't an IRS agent. He was an enrolled agent allowed in a practice in front of the IRS and represents taxpayers. And I helped him with taxes as a teenager, and I learned a lot. So I know taxes very, very well. And I'm not going to tell you how to do your taxes, but I'm going to give you some advice when I see your tax return that says, hey, based on what you've given me, you're going to qualify for this much. But if you tweak the numbers a little bit, maybe you'll pay the IRS a little bit extra in taxes, but you're going to qualify for a whole lot more in a house price. It's a trade-off. It's something you have to decide if it's worth doing. But just recognize that as a self-employed individual, we're going to scrutinize what your taxes look like. And if you pay yourself a paycheck, I don't care how much you can give yourself a raise. I hear it every day. Oh, John, I pay myself $5,000 a month, but I can raise that as high as you need it to be. Well, obviously you can. The problem is that doesn't change the underlying profit of your company. If your company makes $10,000 a month in profit and you pay yourself a $6,000 salary, then there's $4,000 left over in company profit. If you pay yourself a $15,000 a month salary, your company didn't make $180,000 a year. you're just in the hole by $5,000 a month. You're paying yourself more than the company actually generated in profit. So to oversimplify how we look at self-employed people is we take what you paid yourself on your paycheck plus what your profit was for the year you last filed your taxes. And I add those together and that's your total income. So it is super critical that you talk to me before you file your taxes so that I can help give you advice on how to make sure you qualify for the most you possibly can if you're self-employed. All right, so that is cash, credit, and income. I told you there's 3 things that we care about, and guess what? I lied. Yes, that's right, I lied. There's a 4th thing we care about, and that's the property. Now, the property really comes down to, by the way, the reason I talk about cash, credit, and income is because those 3 can balance each other out. So if you're really good in 2 of them and weak in another one, we can probably find a solution. But if you're weak in 2 of them, it's going to be hard. And if you're weak in all 3, we're going to have to set a game plan and we're not going to qualify right away. But for the most part, if you've got great income and great credit, I can make up for a limited down payment. You got a great down payment and great credit, we might be able to make up for limited income. And if you have great income and a great down payment, we're going to be able to make up for not so great credit. So those 3 balance each other out a little bit, and having 2 super strong can make up for 1 that's weak. But property stands alone. So the property comes into 3 things: value, condition, and type of property. When you buy a home, the types of loans, I do what's called a renovation loan, where you can buy a house that's in horrible shape and I can loan you the money to renovate it. But and I have a 1-hour webinar on how those renovation loans work in my YouTube channel, youtube.com, search John Loan King, and I can tell you all about how that works, or you can set up a meeting with me and I'll tell you about it. But for the most part, most loan programs are going to require that the property is in livable condition with no health or safety hazards. So that's where the appraiser is going to go out, and the appraiser is going to confirm that for me. They're going to confirm the value is worth what the house is worth, what you're paying for it, and that the condition is livable with no health or safety hazards. So that is not the same as a home inspection. A home inspector is going to go through and check everything about the home. They're going to test every single outlet to tell you if every single one of them works. They're going to flush every toilet and turn on every sink to make sure it all works. The appraiser just says, hey, I walked in, I turned on a light switch. Great, electricity. I'm going to turn on a sink and I'm going to turn the hot water on. Well, hot water runs, that means we have running water. The water drained, that means the sewer is working. And the water turned hot, which means the hot water heater is working. I'm done checking those 3, they all work. He or she is checking the basic operation of the home. They're not double checking every detail. So even though you got to pay $500 or $600 for an appraisal, you still really should spend, I don't even know what a home inspection costs right now. Chris, you probably have a better idea what a home inspection is, but I'm going to say probably $300 or so for a home inspection is likely what it's going to cost. Chris, if you're listening, go ahead and post in comments for us what a home inspection costs, just so everybody knows. By the way, the 3rd thing we care about is the type of property. So what is type of property, John? Well, there's single family homes, which is most common, but then you can do a duplex, a triplex, or a fourplex. And that changes how we look at the loan depending upon what type you're doing. But the 2 biggest types that create issues is manufactured homes and condominiums. So the rules are different when you're buying a manufactured home or you're buying a condominium. And if you're thinking about doing that, you need to talk to me, because specifically the least expensive by the way, Chris just said about $315. Thanks, Chris, for a home inspection. So you're gonna pay $500 or $600 for an appraisal. You have to do that, but you really should invest that extra $300 or so to get a home inspection done. So the reason why a manufactured home and a condo is challenging is because not all manufactured homes qualify for mortgages, and not all condos qualify for mortgages. I'm going to go briefly through this and simply say the least expensive manufactured homes are typically in a park. Well, that means you're renting the land and it's not considered real estate. So I've had clients, I had a client this week who was looking at manufactured homes and showed me some homes under $200,000. But she was saddened to hear that we can't finance those because they're in a park and it's not considered a real estate loan. It's a whole different type of loan that requires a much, much bigger down payment, and the interest rates are higher. The condo issue is not that condos are in parks or rented land, that condominiums are mandated to have certain financial health of the homeowners association. And a lot of the least expensive condominiums are inexpensive solely because their association doesn't meet lending guidelines. And the only buyers who can buy are buyers who are paying cash. So if you're searching for a condo and you're out looking and you say, man, I'm looking for a 3-bedroom, 2-bath, and I'm looking around this neighborhood and in this town, and most of the condos are running about $300,000, $1,000. But I see this one in this one subdivision, that this one homeowners condo community that is $75,000 cheaper, and it's a 3-bedroom, 2-bath. It looks identical. Well, I'm going to buy that one. Chances are it's $75,000 cheaper because you can't buy it, and neither can anybody else getting a loan. The only people who can buy it are people who are paying cash. And that's a very disheartening issue that comes up, because you think, man, John said I can qualify up to 250, and I found this great condo for 2.25, but you can't buy it. So just be aware. It's very frustrating. I get it, but it's something I want to make sure you're fully understanding. All right, so we've got about 30 minutes left. I want to make sure I'm covering questions that you guys have, but I want to give you some big picture thoughts on this, and I want to leave a good amount of time for what's happening in the market right now. The mortgage industry has been tightening and tightening and tightening since 2008. We were blamed for collapsing the global economy, and there's a lot of challenges right now between the economy being in flux, the war in Ukraine, inflation, mortgage guidelines are changing. People are afraid that there's a bubble, and it's creating a lot of uncertainty in the industry, and it's creating a lot of challenges. So what I want to explain really quick is a quick readjustment of your thinking about the home buying process. The truth is, the home buying process is very much like flying in a plane. And most of you have probably flown in a plane before, and you know that when you fly in a plane, you're likely to hit turbulence. And it's not the sign of a bad pilot. Pilots don't have a choice. They'll see the turbulence, they'll see it coming, they'll tell you to put on your fasten seatbelt sign, they'll have the staff not serve drinks and food so that you don't spill hot coffee on your lap, and they have no choice. They have to fly right through the turbulence. Your realtor and your lender are kind of the same way. There is lots and lots of turbulence that happens in the home buying process. And if we could predict it all, it's just like the pilot that could predict where the turbulence is going to be, but there's no choice but to fly right through it, because when it comes up, they're facing it, and their choice is they could go around it, but they're going to run out of gas and crash, or they can go around it and add an extra hour to the flight, and now you're late. I think it's better to just fly right through it, but you got to make sure you have a good pilot, and that's having a great lender and a great real estate agent. So let's talk about the process of what happens. The first step is you need to get pre-qualified, or really you need to get pre-approved. Okay, so that starts with you giving me a call. Again, I'll have a form at the end you can start filling out that'll give you a rough idea of what you'll qualify for. That's a pre-qualification isn't really anything you can use. A pre-qualification is me saying, here's a rough idea of what I think you're going to qualify for. What you really need is a pre-approval. That means I've pulled your credit. That means that I have checked your income documents. I've looked at your assets, and I say, yes, Mario is qualified. Mario can buy a house. And so I'm giving Mario a pre-approval letter, and that's Mario's ticket to go find a home. Now, at that moment, you need to have picked a real estate agent. If you don't have a realtor already, let me know. I can connect you with an absolutely amazing realtor. I know a lot of great realtors across all of California. But I caution you, pick one agent and stick with that agent. Now, if there's a problem, if your agent isn't communicating well, talk to them about it. And if they're still not doing what you need or expect of them, then go get another realtor. The thing people misunderstand is they think that, well, I'm not paying for the realtor, the seller is. That's true. So I can have 4 realtors shop for me, and hey, whichever one finds me a home, well, they deserve the pay. You're actually doing yourself a disservice, because when you go out with 4 different realtors, they're each going to get 1/4 of your feedback on what you're really looking for, and you're going to waste a lot of time looking at homes that don't meet your needs. Because you told one person that, man, this house is great, but this backyard just doesn't feel right. And then you're going to tell a different realtor, hey, this house is great, except the kitchen doesn't feel right. I need a bigger kitchen. And now only one of them knows you have a problem with a specific backyard, and one of them knows you have a need for a specific kitchen. And you're going to end up having a worse experience, and you're not doing it right by the realtor. The truth is, look, people think being a realtor is easy. It's not. People think that realtors are overpaid. They're not. The truth is, the average realtor is closing maybe 3 or 4 transactions in the last year. That means they're working 40 hours a week, 52 weeks a year, and they're getting 3 or 4 paychecks. So they're decent sized paychecks for sure, but they're only getting 3 or 4, and they got a chance of getting none. So don't shortchange your realtor. Don't think that they're overpaid. They're not. But use a realtor for what they're experts in, which is to help you figure out what you're looking for in a home. Once you get your offer accepted on a home, that's when we can lock in your interest rate. So that's step 2. Find your home, write an offer, get your offer accepted. We lock in your interest rate. That's when steps 3 and 4 happen, where the loan is actually processed and underwritten. That's the mortgage industry doing our work, making sure that we dot every I and cross every T. That's where some turbulence sometimes comes in. That's where we end up asking you for new paychecks and new bank statements, and we got to explain that new deposits. So just be aware that even if I verify and when I verify everything in step 1, I have to re-verify it all again in steps 3 and 4. Okay. That process from getting your contract accepted to step 5 of signing your home takes about 21 days on average right now. I can move faster. It can take longer, but I'll tell you the average is about 21 days from start to finish. And it's kind of crazy because I have people that meet with me all the time saying, oh, John, I'll buy at some point down the road, and they're sitting down and they're ready, and we get them pre-approved, and they go out this weekend and they find the right home and their offer gets accepted, and within 3 weeks they're homeowners. Like, sometimes it's scary how quick it happens. It only happens when you're ready. But when you're ready, it's kind of crazy how things can come together pretty quickly. And then step 6 is you move into your new home. So let's talk about some of the types of loans. I'm not going to spend a lot of time on this. I just want to kind of educate you on a couple of big picture things. First of all, I realized I didn't update the slide for 2023. So you've got conventional loans. Conventional loans are really 2 different government entities called Fannie Mae and Freddie Mac. I'm sure you've heard those names before. But how I want to explain them to you is I want you to think of them like the Coke and Pepsi of the mortgage world. Okay, they're 2 different recipes that I use to help you determine what is the right loan program for you. So we call that conventional, but I'm really picking between Fannie Mae and Freddie Mac. And currently, the limit is now, instead of $647,000 loan amount, we can go up to $726,000 as a loan amount nationwide. And in some areas, I can go higher. Okay. And you see that, a conventional loan, you need to have a stronger credit score. Your debt to income ratio likely needs to be better. It's ideal to have more cash out of pocket versus what we call government loans, which is your FHA, your VA, and your USDA. Those are more forgiving, lower credit scores, smaller down payments, higher debt to income ratios. And then the final category is a jumbo loan. So those are for the big loans. If you're looking to buy a much larger home, a higher priced home, just understand the guidelines on those are totally different. As a matter of fact, last week on Friday, every Friday I do a Financial Friday video, a live stream. Typically it's at noon. This Friday it's at 2. I have a doctor's appointment that I got to get to at noon. So I moved it to 2 o'clock. But last Friday I did a financial 1 hour, 45-minute video on jumbo loans and how they work and how that market is changing. So again, you want more details on this stuff, go to YouTube and look up my channel, subscribe to my channel, John Loan King on YouTube, and you'll be able to get a lot of this information. So jumbo loans are a whole different beast, a whole different type of loan program. All right. So again, guys, if you have questions about anything, let me know. I've got a lot of stuff I'm still going to go over, but I've got room for questions. So let's cover some other common questions. The first one is, how do I pick a realtor? The first thing you want to do is you want to look for recommendations from people that have bought or sold a home in your area. And It's often that simple. I've got great realtors that I can connect you with. So if you don't know somebody, I'm gonna connect you with a great realtor. But the reality is you are better off using a realtor than trying to do it yourself. There are legal issues that you need to be aware of. And most important is don't go to the listing agent in thinking you're getting a better deal, because the listing agent is the person that represents the seller. And you might get a better deal. Let me say it that way, because look, the listing agent might say, hey, I'll cut my commission since I'm getting paid both pieces of commission. I'll earn a little bit less. That'll maybe lower your price. That'll maybe get the seller more incentive to pick your offer, but you're getting less quality representation. The truth is, if you pick the listing agent to represent you, then it's just like picking an attorney that represents the guy that's suing you. Sure, he'll do it for cheaper because he's already going to be at court, so he doesn't have to he gets paid more money to be in the same place he was going to be at anyway, so he'll do it for cheaper. But he's representing the other guy. So his best interest is not solely focused on your best interest. And that is the simple, single reason why I caution you against just picking up the phone and calling a listing agent. Find a realtor who's going to look out for your best interest, pick them and have them write the offer for you. All right, so the next common question is, John, how soon should I get pre-approved? Here we are, it's January of 2023. The lease on my apartment isn't up until June, so I got 5 months to wait. I'll call you in June. You can, but I worry about things that you could have addressed that you didn't know about, and you just squandered the time you had to address them. A good example we've already talked about is income. If you're self-employed, you need to be talking to me now. If you're thinking about buying a home anytime in the next 2 years, so I can look at your prior year's taxes and I can help you file this year's taxes in the best, most advantageous way. If maybe you have something with your credit that you weren't aware of, you're going to end up pulling your credit. I'm going to pull your credit in June and I'm going to say, oh man, we got to pay off some debt. It's going to take 2 months to get your credit up. Well, don't you wish you had known about that in January or February? And then there's the question of being prepared if the right thing comes along, because there's something called the reticular activator. If you know what the reticular activator is, or if you don't know what the reticular activator is, it is your eyes, your retina, will see what your brain is thinking about. So if any of you have children, when you were pregnant or when your spouse was pregnant with children, did you not notice a whole bunch more people walking around this world that were pregnant or that had babies in strollers? You did. Same holds true on the car. If you buy a new car, you buy a yellow VW Bug, amazing how many yellow VW Bugs you see on the road. Why is that? Your reticular activator. What you're thinking about is this yellow car that I just bought, and your eyes spot that. When you're thinking about buying a home and you say, hey, I'm going to buy a home in June, and I'll wait until then, but you're looking around at homes and you're going to see the perfect home and you won't be in a position to make it happen. And then we're trying to rush to make it happen. Rushing doesn't make anything better. So we need to start early. So that brings me to my next question. And this is probably the biggest part of this conversation. And that is now a good time to buy? First of all, if you're here, I'm guessing that you think it is, or you're wondering if it is. And so let me give you, first of all, I'll tell you 2 weeks ago, I did a webinar, my Financial Friday, 2 weeks ago. You can find it on my YouTube channel. And I spent 40 minutes talking about where I think the housing market is going, where I think interest rates are going, and what my outlook for 2023 is looking like. By the way, if you want me to, if you can't find those on my YouTube channel, call me or shoot me an email and I'll be happy to send you the link to it. But the fact is, I spent 45 minutes explaining what I'm going to explain right now in 4 minutes. It's this simple. There are not enough homes built for the number of people that need them. So there is demand, high demand, with low supply, low number of homes. That happened because of the crash in 2007. And again, I don't have the time to explain all of the reasons that led to that. But the bottom line is, in 2020 and 2021, we saw that exacerbated by super low interest rates, which caused all the buyers to want to buy. And there weren't enough homes to buy. So we had bidding wars. Then in 2022, interest rates shoot up. And interest rates are the reason why housing prices have slowed down and started to drop. because buyers either can't afford to buy a home with the high interest rates, or they aren't willing to pay those high interest rates. By the way, rates, I believe, are on their way down. Now you might say, gosh, John, that's great news. I'll wait until rates get all the way down before I buy. The problem is when rates get all the way down to wherever they're going to get to, everybody else is going to be buying too, and there's still not enough homes for sale. So I believe right now is the time when the window is starting to close. Interest rates peaked at 7.3% in October of 2022. They've been slowly going down. Right now, they're around 6.1. They also, on their run up in 2022, had shot up from around 3% at the beginning of the year to about 6.5% in June. And then they came down in July and August, and they went back down to 5. But when they went back down to 5, a whole bunch of buyers started buying again, and prices started going up a little bit. And then the Federal Reserve said, nope, that's not good. And they made some announcements that caused interest rates to go back from 5 past 6.5 and up to 7.3. Now, I don't think that's going to happen again because inflation is now proving to be in check. It's not raging out of control. It's not solved, but it's not raging out of control. And so as we see inflation come back down, inflation is what caused interest rates to go up. And that's what caused housing prices to start to come down. But we've already seen 3 straight months of inflation starting to come down. And we've seen over those same 3 months, interest rates start to come down. And I think we're going to see, I'm seeing right now more buyers like you guys who are here that are saying, maybe I should buy a home now. And as rates start coming down, each time rates creep down more buyers want to buy. And that is not a good thing for you. Instead, what you do is you buy now, you bite the bullet on today's interest rate and payments, and then in a couple of years, you refinance. Because I expect interest rates to be back down in the 4s within the next 12 to 18 months. So even if you have a 6% interest rate right now, you'd be able to refinance that in a year and a half to something in the mid 4s. Obviously, what I'm saying is predicting the future, and nobody can do that. But I have a reasonable expectation, having done this for 22 years. I listen to a lot of super smart people and I study the information myself. And I feel very strong that the cycle is moving that direction because we have a serious shortage in housing. If you want more than that 4-minute version of how that went, again, go to my YouTube channel, John Lone King, youtube.com/John Lone King, and look for the video that I did. It was the first Friday, whatever that was, Friday the 6th of January, where I did my 2023 outlook, and you'll get a lot more detail on why I think now is the perfect time to buy a home. All right, so let's go through a couple of more slides here as we're wrapping up. So a lot of people are asking questions about interest rates and how all of this works. And so let me be clear. Your rate does determine your payments. It is really your home price equals your down payment and your monthly payment. Let me say that in a different way. When you say, hey, John, I want to buy a $500,000 home. So that's your home price. Then I'm going to ask you, hey, what's your down payment? How much money are you coming up with? Oh, I got 10% down. Great. Then I'm going to use that and come in conjunction with today's interest rates to determine your monthly payment. But we don't freeze the rate until you get an offer accepted on a home. Okay. So the second box I said was inflation has definitely been driving this run up in interest rates. And I've had a lot of people ask me, hey, John, should I wait for rates to drop? Well, I think I just explained that. If you wait for rates to drop, you're going to have a lot of buyers who are also going to be competing with you, and you're going to pay a whole lot more for the home. Okay. Sam asked me a question. How long after you purchase a home can you refinance? Sam, that is a great question. By the way, I very much appreciate you posting a comment so that I know I haven't put all of you to sleep. So thank you for somebody commenting, Sam. So there's typically 7 to 8 months after you purchase a home is about the timeline that you need to wait before you refinance. There's some circumstances where you can do it sooner, but for the most part, it's 7 to 8 months is how long you need to wait. But it absolutely has to do with where are interest rates at the time you're refinancing and where are house prices. And so one of the things I do for all of my clients is I pay attention to the markets, and I'm looking and saying, hey, right now rates have fallen. Right now rates are at 6.1%. So anybody I did a loan for in the last year that has a rate over 7, I should be talking to them. Now, there weren't that many, and the few that I did, they were done in October, and it's not been 7 months. So the timing's not right for them to refinance, but I expect we're going to see rates continuing to trickle down. And so my advice to that client would be, hey, let's wait anyway. Even though I can save you some money, we don't want to, there's a cost to refinancing, okay? And that fee is added to your loan, but you don't want to do it more often than you need to. Chris asked the question, probably was typing it just as I was saying that. So Chris said, what are the closing costs to refi? It's almost exactly the same as the closing costs to purchase. Now, you're not paying for a home inspection because you already know all the issues with the home, but you're paying for an appraisal, you're paying for underwriting and processing, you're paying for title insurance and escrow fees. You pay almost the same fees as you pay to purchase a home. So you're looking at maybe another $10,000 that's added to your loan balance. Now, if I can save you $1,000 a month in interest, it's an easy deal because you're going to save that in just the first 10 months. So that's what we call break-even analysis. In general, it's a good idea to refinance if you can recover your costs in the first 3 years. That's a general rule of thumb. There's times when that isn't even worth it and that you need to recover your costs sooner. So that's really a market by market kind of, is our rates going down? Are they going up? Where do we see home values going up or down? That helps kind of decide, hey, how quickly do we need to break even? Because you don't want to take 10 years of making monthly payments before you've recovered the upfront cost. Most people, they don't keep a home longer than maybe 5 years. Now that's changed in the last few years because people have really, really low interest rates. They're going to keep those homes for a lot longer, but those are people that bought their home or refinanced in 2020 or 2021. If you're buying now, you're going to want to refinance sooner, but it's a matter of figuring out the break-even point of what the closing costs are compared to how much it's saving you per month. So Sam, Chris, those are great questions. Guys, as I'm wrapping up, I'm not done, but as I'm wrapping up, I really want you to get your questions out there. So if you have questions, please post them so that I can make sure that I can answer those for you as we wrap up here in the next 10 minutes or so. All right. So the last question on here is, should I wait for home prices to drop? That's a big question that people are concerned about is, hey, John, I heard foreclosures are coming back and housing prices are going to crash, and I want to wait for housing prices to drop. Well, I'll tell you what, the only crash we had with foreclosures, and really the only crash we had in the housing market, was back in 2007. And I'll explain really quick, although in my economic forecast video from a couple of weeks ago, I explained it in a lot more detail. That's not going to happen. We don't have a bunch of people that have adjustable rate mortgages that can't afford their payment. As a matter of fact, our problem is that all the current homeowners have super good interest rates, or a majority of them do. So they're not going to lose their home to foreclosure. And as a matter of fact, they have no desire to even sell their home, which is exacerbating this inventory issue, the lack of homes for sale that I expect to drive home prices back up as buyers start coming back in. But let's pretend I'm wrong. Let's pretend that house prices crash. First of all, the only reason what has caused housing prices to start going down is interest rates going up. So if housing prices are going to drop even more, it's because I'm wrong about rates and that rates are going to keep going up. And there's some people saying we're going to have an 8 or a 9 or a 10% interest rate. Well, imagine how much the payment's going to be then. You're going to have a huge monthly payment. You won't be able to qualify for it, and you won't be able to afford to make that monthly payment. So waiting for home prices to drop means you're paying a super high interest rate. So is it really a good idea to wait? I don't think so. I think if rates do skyrocket, you'll be happy you got a rate in 6%. And if things go where I expect them to go, which is that rates are going to go down and house prices are going to go up, you'll be happy you bought the house now and you got to do inspections, unlike your friends who bought them in 2020 without having an inspection contingency. So it's critical to understand timing right now is really, really important. All right. I want to give this out just kind of as a general idea of how interest rates work. You go online, you can go to any bank and you can click on their mortgage site and you can see where their interest rate is. And they're all accurate, but none of those rates are yours. There's 30 different factors, and that's just some, that's a majority, but that's not all. Those are some of the factors that come into play when we are determining what your interest rate is. So when you say, oh my gosh, John, my friend last week got a rate of 6.2 and you're telling me a rate 6.4, well, that's because these 30 factors aren't the same for you versus them. And so you've got to be aware of the fact that even on the same day, a bank is going to say, oh my gosh, our market rate is right here. But that's the rate based on their disclaimers. And their disclaimers say, specifically based on this credit score, based on this down payment, based on this loan amount, they go through all of these things. What are the chances you're all of those exact things? Slim to none. And then you do the worst thing that people do, which you say, I'm going to pick a lender based on the interest rate they quote me, but they didn't even quote you a rate that was accurate for you. They just happened to quote a rate that had the most beneficial of these 30 factors assumed. Versus other banks like me are going to say, you know what, I'm not going to show you the best case scenario. I'm going to show you an average or maybe worst case scenario, because that way the truth is likely to be better. All right. So I think we talked about most of this stuff. About the only thing on here, we didn't talk about mortgage insurance. The truth is mortgage insurance is a fee you pay for the privilege of putting less than 20% down. Now, there's some ways that you can avoid paying mortgage insurance, but you're really paying it. I had a client today tell me, hey, John, I'm thinking about going with this other bank because they won't charge me mortgage insurance even if I don't put 20% down. And I said, oh, is their interest rate the same? And they said, no. I mean, they bump the interest rate a little bit, but they don't charge me mortgage insurance. Well, guess what? They're charging you mortgage insurance. There's actually 3 ways to pay mortgage insurance: a monthly fee, a bump in your interest rate, or a bump in your closing costs. They just tell you they're not charging mortgage insurance because it's the most common way that people expect mortgage insurance to show up. We talked about job history, and that really isn't as big of an issue as people think it is. Co-signers are very, very helpful only for a lack of income. Your down payment, if you need help with down payment, get a gift. They don't need to co-sign. If you have an issue with credits, your co-signer won't help you with credit, because we look at the credit score of the worst scoring applicants. And so if your credit's really low and your co-signer's credit's really great, it doesn't help us because you still have really low credit. Now, there's some loopholes to that, but for the most part, co-signers help the most with income. And we already talked about credit, how important credit score is, so I don't need to go through that part. I want to go through one last thing, which is the financial benefits of owning a home. Now, this is really a high-level overview, but I'll tell you that most people think the only benefit to owning a home is appreciation. Appreciation is how much house prices go up. And so, hey, John, if house prices don't go up, this home ownership thing's a sham. It's not worth it. But it is for 3 reasons. Appreciation is one of them. I just use an example here on a $350,000 purchase price. If that home goes up 2% per year, most homes go up between 3 and 4% a year nationally. So over time, 2% is super conservative. That's $7,000 a year it goes up, or $583 a month, that you're getting an additional average value increase to this asset that you call your home. And you'll get that money when you sell the home. So that's appreciation. But you also have a forced savings account, because as a renter, all the money you spend in rent goes to the landlord. None of it goes to you. Imagine if your landlord said, hey, of your $2,000 a month in rent, I'm going to take $300 of it and put it in a savings account here every month. And at the end of the year, you're going to have $4,000 or $3,600 in that savings account, and I'll give it to you if you want. Well, that's a great, really nice landlord, but that really isn't realistic. That's what the bank is doing. The bank is saying, hey, make a payment, and part of your payment is principal. We're paying down your mortgage balance, which means you owe us less money. And when you sell your home, you'll have more of it left over for you. And then tax write-offs. So a tax write-off, if someone is looking at, a $320,000 loan, including property taxes, you're saving about $590 a month on average. Check with your tax advisor on that one. Calculations are different for everybody, but you can save about $590 in lower tax bills than what you would have paid in income taxes if you weren't a homeowner. So add those 3 together. You've got $590 in lower taxes every single month on average. You have $300 a month that you've got in forced savings and $583 a month in average appreciation. That's almost $1,500 a month in money that you're building as wealth, as making you, it's homeowners are 10 times more wealthy than renters. These are the reasons why. So really, really important to understand the financial benefits of owning a home. The last thing before I wrap up is who you choose to do your financing matters. The reputation of that lender matters critically. What the lender does before you write an offer. Part of what I do as part of my services is I actually call the listing agent and talk through your qualifications and how we're going to make sure we take great care of them and the seller. Just so in case you're really neck and neck with an offer, they're going to pick the offer from the lender that started communicating early and shared a lot of really good how do I want to say it? Not good information, but set a lot of good expectations that we're going to take care of them better than the other lender. We will fully review your credit, your income, and assets to make sure that you're not going to run into issues down the road and be one of those stories that your family tells about that guy who tried to buy a house and failed. We'll help you remove your contingencies quickly, and we will close quickly. And those things matter in you making sure, because here's the deal. A lot of people read the news and they say the housing market is slowed down and it's a buyer's market. It is across the board, but I'll tell you, the best homes and the best neighborhoods, it's still a seller's market. You still have multiple people bidding on homes and they're selling right away. So don't think that the market is something that you can just offer whatever you want. You've got to listen to your realtor. So gang, that's about it. I'm a couple minutes over. I appreciate most of you sticking around through here. If you're ready to start the process, this is no obligation. It's a short form you're going to fill out, just answering some basic questions. You're going to tell me a little bit about how, I'm not going to pull your credit. You're going to tell me a little bit about how much money you make, what price range you're looking at. You answer those basic questions and I can work some numbers for you and tell you what you may qualify for. So if you want to just get a feel for what things are going to look like, scan that QR code. If you want to follow me, I'm on all of the social media channels. So you can find me at John Loan King, whether that be a lot of my videos are on YouTube. Gideon, I appreciate the thank you and the appreciation. Mario, appreciate it as well. And if you want to check out my website, it's johnloanking.com. So really everywhere you go, just look for John Loan King, and don't fear sitting down and having a conversation. I don't bite. A few people on this call have used me before, and they know that I'm focused on helping to educate you. So I do this workshop every month on the third Thursday of the month. And I'm going to update on market conditions. So if you want to get a repeat of what we talked about, a lot of what I said, I'm going to repeat again, but I'm going to update you next month on where the market's at and what I see and where things are going. If you have a friend or a family member that you think might want to buy a home, this would be great for you to send them to this workshop. So it's howtobuymasterclass.com. Again, howtobuymasterclass.com. Please send your family and your friends so that they can get this great information. I look forward to helping each and every one of you to purchase a home down the road. And if you have any questions at all, don't hesitate to reach out. So I'll be on for another minute in case anybody has any questions. Maxine, I appreciate that wonderful comment. She said this truly demystified the process. Well, that makes me feel good. That was absolutely my goal. And I appreciate you trusting me to help guide you through this process. So everybody go ahead and feel free to sign off if you don't have any questions. I appreciate your time on this Thursday night. Hope you have a wonderful evening, and go Niners. If you're not a Niners fan, I'm not going to help you with your mortgage. If you are a Niners fan, I'll do everything I can. Thanks, everybody. We'll talk to y'all later. Bye-bye.